Good morning. These are the things that matter most in the U.S. market today. The AI trade is facing another proof test. Oil has jumped back into the inflation story. Consumer earnings are separating strong brands from weak demand. And one quieter signal is that artificial intelligence is now moving from market hype into real corporate cost structures. The central question for private investors is simple. Is Wall Street still in a broad risk-on tape? Or is it becoming a market that rewards only companies that can prove margins, cash flow, and pricing power? Start with AI and megacap technology. Investors are no longer treating AI spending as automatically bullish. CNBC reported that Amazon, Meta, and Microsoft faced skeptical investors this week after Google's report sparked a sell-off, while SK Hynix shares fell even though the company still showed very strong AI-linked growth. Apple is also in focus, with Tim Cook's last earnings call coming while the stock sits near records. The market is not asking whether AI matters. It is asking who can turn spending into profit without burning too much free cash flow. The cleaner side is companies that can show paid AI products, cloud demand, pricing power, or operating leverage. Pressure sits with names where the story depends on very high capex, perfect execution, or long-dated promises. For private investors, the practical takeaway is this. AI can remain the most important theme in the market and still become a tougher stock selection test today. Second, oil risk is back on the U.S. screen. CNBC reported that oil prices jumped more than 6% after President Trump said the U.S. would hit Iran hard, and MarketWatch reported rising oil prices after U.S. and Saudi attacks on Iran-backed militias in Iraq. For Wall Street, this is not just an energy headline. It can change the read-through for inflation expectations, treasury yields, airlines, transports, and consumer margins. Potential beneficiaries are energy producers and selected service names if crude strength holds. Pressure is more visible in airlines, retailers, transport companies, and rate-sensitive growth if higher oil feeds inflation anxiety. In plain English, the takeaway for private investors is this. Oil can help one part of the index while quietly taxing the rest. The useful confirmation map is Exxon, Chevron, and the energy ETF on one side, and United, Delta, transports, and rate-sensitive tech on the other. Third, earnings quality is splitting the consumer tape. Procter & Gamble revenue missed estimates as volumes stayed unchanged. Nike remains under pressure in China, where CNBC reported sales have fallen 30% from its former position as sneaker king. Yum Brands faces attention around a Cyclospora outbreak tied to Taco Bell, while Ford raised guidance after a second quarter beat and said its F-Series recovery is on track. The common thread is not one sector. It is whether demand, pricing, and execution are strong enough to protect margins. The stronger side is companies with repeat purchases, pricing discipline, resilient volume, or credible turnaround progress. Pressure sits with brands that need China, low-income consumers, or clean execution to improve quickly. For private investors, the filter is to separate brand popularity from earnings momentum. A famous name is not enough if the numbers do not confirm the story. The underappreciated story is Visa cutting 7% of employees in an efficiency push as AI reshapes work. That sounds like a company-specific cost story, but it matters because it shows where the AI debate is moving next. The first AI market phase was about chips and data centers. The next phase is whether large companies can actually use AI to lower costs, protect margins, and redesign work without damaging service quality. The cleaner side is networks, software platforms, and high-margin companies that can use automation without weakening the customer relationship. Pressure sits with firms where AI savings look more like defensive cuts than growth. For private investors, the takeaway is that AI productivity needs to show up in income statements, not just investor presentations. Visa, Mastercard, American Express, and the large banks are the useful confirmation group. Here is the stock-led watch list. Meta, Microsoft, Amazon, and Apple. Does the market reward AI spending when it comes with clear monetization or punish capex that outruns cash flow? Exxon, Chevron, United, and Delta. Does oil strength lead the tape, or does fuel pressure hurt the broader market mood? Procter & Gamble, Nike, Yum Brands, and McDonald's. Are consumer brands showing pricing power, or are volumes and demand still fragile? Visa, Mastercard, American Express, and JPMorgan. Does AI-driven efficiency look like real margin support, or like a late-cycle cost-cutting signal? Market bias, selective, proof-driven and inflation-sensitive. The market can still find winners, but broad theme buying is harder when oil is rising and earnings are being judged by margins, not headlines. The mistake to avoid is treating every AI, oil, or earnings story as the same signal. Today, the better filter is confirmation, which baskets validate the story and which ones refuse to move. That is the U.S. Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice.